So welcome everyone to today's first lecture here in this class on quantitative risk management. My name is Gregor Weiss. I'm a professor of finance here at Leipzig University, and as you've probably by now have seen, this semester we'll see an online held lecture, and we'll have this class via virtual e-learning. This is the first time I'll be teaching quantitative risk management here at Leipzig. I used to teach this back at Dortmund University, but this is actually the first time we'll have this here at Leipzig. I will first start and talk a little bit about the course organization, the course outline. And as you can see, we have a lot of topics we want to deal with and a lot of things we have to cover here. We'll start out with the different types of data and descriptive and inferential statistics as the very basic a foundation for any analysis in quantitative risk management. We'll then start with pretty simple and basic statistical distributions and stochastic processes, because in the end, quantitative risk management is about stochastic and statistical modeling of financial return data, of financial loss data. If it's known, if it's deterministic, we don't need to deal with this here in quantitative risk management. And then after having talked about the statistical background, we'll talk more about Monte Carlo simulation, time series analysis, different sources of risk managers and risk forecasting, before concluding with extreme value theory. And we'll also have two add-ons, survival analysis and credibility theory, which are only relevant for those of you who want to take this class and who want the exam for the German Actuarial Society. Okay, so let's start with the course organization. As I told you, if you have any questions, please write your questions in the chat window, which will not be recorded in this video. Someone has already asked if I will upload the recorded videos in Moodle. No, these will actually be uploaded to YouTube, just like in the previous semesters. For the video being uploaded to Moodle, I would need to record it in Big Blue Button. And as I've told you, the Big Blue Button servers are currently down, so we'll just stick to YouTube. And I will insert the link to the YouTube playlist in the Moodle course. Okay, so let's start with the basic course organization. We'll have 2 hours. So it's always Mondays from 1 to 3 p.m., 1 hour lecture, 1 hour tutorial. It's mixed. We'll have a lot of examples and a lot of small exercises in between. So it's basically a 2-hour class with some lecture and some tutorial elements. It's an optional elective course in the Master of Science in Business Administration, BWL Master. It will conclude with 5 ECTS points, and this is something different now compared to other classes. The assessment is done and the grading is done based on a term paper, for which you will have 4 weeks time. And this term paper is on a quantitative modeling task in R. So you will be given a task, you will be given data, and you need to estimate certain risk measures, you need to forecast certain risk measures, and this will all be explained in detail in the Moodle class. And you will have to do this in the statistical program R. Most of the examples and most of the tutorials we have in the script, they are given in R, so you will have some knowledge already for working with R, and this shouldn't be a problem. Now, if you are an Erasmus student or an exchange student, just like everyone else, you have to write the term paper to earn the 5 ECTS points. So you have to do the modeling task as well. There is no Erasmus paper, so it's the same exam. And the resit exam is at the end of the summer term. So make sure that if you fail the exam, there will not be a resit exam, for example, in April, but it will be again in July, August 2021. Now, e-learning, for this semester, we've moved all the material from my personal website to Moodle courses. And Assuming that our Moodle servers will be working again in a couple of hours, you will find all the material on Moodle. As I told you, all these lectures are recorded and uploaded on YouTube, and you can watch those videos on YouTube. Because this is the first time I'm giving this lecture here at Leipzig, you will not find any lectures, any recorded videos from previous semesters, but only the ones we're having here right now. The consultation hour, this is a link. You can click on this link and you will go to calendly.com/Gregor Weiss, and you can make an appointment for a consultation hour. This semester, due to the COVID pandemic, we'll have these consultation hours via Skype. I think this is the best for all of us. And if you feel the urgent need to write me an email, you can write me an email at weiss@vifa.uni-leipzig.de. Again, the lectures are recorded on YouTube. Just click on this link here and you will be prompted to the playlist and the video channel. Now we do have two mailing lists because every now and then I need to send you an email regarding maybe some job openings for an internship. You can make sure to register for the first one. This is the mailing list for the lecture. We have this just in case because I know not all the students are registered on AlmaWeb. And if I send information around via AlmaWeb, it might be that I miss out one or two students. So if you want to make sure to get all the information, register with and subscribe to this mailing list. And if you want to receive job advertisements, job openings for internships, etc., make sure to subscribe to the second one as well. Now, if you do want to look into a textbook, with this class, just like with any other class that I'm giving, you don't need a textbook. The script, the slides you have here at hand, they're fully sufficient to get through the lecture. That's all you need. But if you want to read a little bit more, I can propose to you this book. It should be the second edition. Might be that there is already a third edition. 2015 seems to be a little bit old. Might even be a third edition now around. But it's Quantitative Risk Management by Alex McNeil, Rüdiger Frey, and Paul Embrechts. A very standard textbook, very famous one, and I can only stress that this is the most and best known book on quantitative risk management. There are a lot of books on risk management, but this one has a strong focus on quantitative risk management, and this is pretty good. Actually, it's also the book on which most parts of the lecture are based on, so it's a good read if you want to do something more than just reading through the slides. The second one is Financial Risk Forecasting by Jon Danielsson. Jon Danielsson is a researcher, is a reader at the London School of Economics and heads the Systemic Risk Center at the LSE. This is a very good book. It's very practical. It doesn't focus too much on the theory and on models you would never use in practice, but it's very practice oriented. And it includes a lot of examples in both R and MATLAB. So this is a very, very good practitioner's book, actually, but it doesn't lack in substance. It's very detailed and it's mathematically, it's challenging, let's call it that way. It's it isn't simplistic or oversimplistic, but it's a very good book. The third one is Elements of Financial Risk Management by Christoffersen, which is somewhere in between. It has a strong focus on the mathematical side of financial risk management. It also includes practical examples. It also includes some coding. So it's somewhere in between the QRM book by McNeil, Frey, Embrechts and the more practice-oriented one by Jon Danielsson. Okay. Now, if you are studying, we'll have a look at the chat window right now. If you're studying economathematics or mathematics, Wirtschaftsmathematik oder Mathematik. It might be that you are interested in taking at some point in your life the exam for the German Actuarial Society, the Deutsche Aktuarvereinigung. As you might know, you can take some of the DAV exams already at university, and if you want to do this, you can take the exam for Angewandte Stochastik as part of the exam for the German Actuarial Society by taking this class. Actually, you need to fulfill and you need to pass 3 exams. This one, QRM, you need to complete the introduction to financial and insurance mathematics, and you need to pass the exam in financial risk management at the bachelor's level. And taken together, all these 3 exams, if you pass all 3 of them and you want us to give you this note, we can give you a certificate that you have passed this exam, Angewandte Stochastik, as part of the German Actuarial Society exam. Just in case, if you're interested, just send me a message or write me an email, and I can give you more details on this. There's a question: are we expected to already have basic knowledge of R? It's basically learning by doing and learning alongside the lecture. As you will probably see today that we'll start with very simple commands in R to access data, to process data, to compute some descriptive statistics. So we'll start with a very basic. If you already know a little bit of R, this is definitely helpful, but it's not a prerequisite. Okay, so this is the course organization. What I'm trying to do here is to make sure that you know the inputs, the tools and techniques for quantitative risk analysis. It's usually about forecasting risk measures. And if you've already taken the financial risk management class at the bachelor's level, you will probably know about value at risk, expected shortfall, volatility, option Greeks, etc. So these are the common risk measures that we'll deal with in quantitative risk management. And it's now our task to use data, come up with a model and forecast most of these risk measures. And this is what quantitative risk management is all about. And we can do this in market risk. We can do this in credit risk, in operational risk management. So we are, it's very general from the perspective of what risk we are dealing with here, but it is mainly focused on the statistical models and the quantitative models we are using. So that's what we are doing. We'll be applying modern methods and actually very old methods also, but some quite modern and new methods in statistics and optimization to solve these problems. And hopefully at the end of the lecture, you will be able to perform our small little quantitative modeling task as part of the exam. If you are interested in the exact dates and the due dates for the quantitative modeling task, I have to refer you to our Moodle website, and all the information for the modeling task are available on the Moodle site. The modeling task will be done during the lecture-free time. So it will be in the time probably February, March 2021. And you will have enough time. You can obviously, you will be, at some point we'll publish the statistical modeling task, and then you can start working on it right away, or you can just leave it until the very last week. That's up to you. Okay. So does anyone have any questions concerning the course outline, the course organization? If so, please write your questions in the chat window, and then I'll give you a minute before then starting with data types and descriptive and inferential statistics. I don't see any new questions popping up in the chat window. So then let's turn to types of data and descriptive and inferential statistics. So we'll start with the very basics here in quantitative risk management. We'll have to make sure that everyone knows what we are talking about. And most of the time in quantitative risk management, we'll deal with stock prices. Stock prices being perhaps the best indicator for the financial well-being of a company, and usually equivalently one of the most frequent investment tools. So investors will invest in assets, they will invest in companies, so they will buy stocks, they will sell stocks. They will also invest in companies in the form that they are granting a loan, they are giving a loan to a company. So they want to know, what is the company worth? Is it close to default? Is it not close to default? And one easy way of assessing, for example, the default risk is to look at the stock price and to see how has the stock price evolved over the last couple of weeks, couple of months, for example. And the basic and the most basic and most important assumption here usually is that all relevant information is priced in the stock market. So the stock price reflects the market's information about this company. So it's the best, or it should be, under this assumption, it should be the best indicator of the financial well-being of a company. If we look at this as a simple equity investor, we would simply say, okay, I want to buy this stock. I want to know what it's worth, where's the current price, and what is the risk that the price goes up or down. So stock prices are probably the most important type of financial data we'll be dealing with here. And more precisely, we'll have to see, are we looking at bid prices? Are we looking at ask prices? Are we looking at the mid price? The difference is that the bid and the ask price give you the price for which you can buy or sell the stock. So you will usually have what we call a bid-ask spread. Let me see if I can, yes, I have something here. The bid-ask spread, what is that? Well, it's the difference between the bid and the ask price. So for example, you might have here a price of 100 and you have a price here of 90, which means that you can buy the stock for 100 and you can sell it for 90. And this difference of $10, for example, this is the bid-ask spread. And the bid-ask spread reflects liquidity. If the spread is small, the stock or the asset in general is very liquid. If the spread is large, it's very illiquid. The mid price is simply taking the bid and the ask price and taking the mid price. So this would be 95. If you go to DataStream, if you go to Bloomberg, and you don't, if you simply select the stock price, it usually will be the mid price at the end of the trading day. So you don't really have one price. This mid price is fictional. You usually have a bid and an ask quote. And the things you can download, say from DataStream, you can also download bid and ask prices, but usually if you only download one price, it's the mid price. And then you can make a distinction between the frequency. Is it intraday? Is it daily? Is it monthly stock prices? Highly important when it comes to quantitative modeling, because the statistical behavior of daily data is completely different from the behavior of, say, intraday data. And I will talk about this a little bit during the lecture, but here at this point it suffices to say that let's say the statistical behavior of intraday data is completely different from that one of daily data. Next, we'll have balance sheet and income statement data. For example, EBIT, ROA. We have assets and liabilities, something from the balance sheet of the company. And it could be total assets, current assets, fixed assets, short-term, long-term liabilities, etc. Quantitative risk management is also concerned at some points about the modeling not just of losses, of financial losses, but also in insurance mathematics, it's concerned about modeling insurance claims. And this is where we need insurance data, and especially in property and casualty insurance. P&C insurance, which in German is simply die Sachversicherung oder auch einfach Schadenversicherung. Very simple, P&C insurance, property and casualty, so insuring a bike, a car, insuring your house. This is P&C insurance in contrast to health insurance and life insurance. Ja. Haben wir im Deutschen genauso, wir sagen ja die Sachversicherung oder die, wie nennt man das noch? Ich komme jetzt auf den Namen nicht. Auf jeden Fall Sachversicherung. Im Gegensatz zur Lebensversicherung. Ne? Also Kranken- und Lebensversicherung sind natürlich komplett anders. So number of claims and claim size, those are the two most important types of data when it comes to P&C insurance, because you have the number of claims, the number of bikes that have been stolen, and the claim size. So every time a bike is stolen, for example, you have a loss as an insurance company of 500 euros, 600 euros, etc. And last but not least, we have macroeconomic variables that we need to account for, that we need to model at some points. Most importantly, interest rates and GDP growth rates, also das Bruttoinlandsprodukt, Wachstum. Okay, if we take a stock price, we can have a look at the log returns. They are shown here. Very simple. These are the log returns of the stock price of Deutsche Bank AG. And as you can see the financial crisis at this point. And you can see the Euro crisis here. And it stops in 2019. And you will probably see a big drop here in 2021 for the COVID pandemic. So every now and then you can see times of high volatility. And what you can already see is that you need quantitative models, you need econometric models that can account for all these stylistic facts. We call these stylized facts. Stilisierte Fakten in German. What are stylized facts? Stylized facts are facts you can observe, but which you cannot explain or which you don't want to explain. You simply take them as facts. And one stylized facts for log returns and stock returns is that you have varying volatility. So this time here, this is a time of high volatility. You have high volatility here again. In between here, you have a time of low volatility, and then volatility increases again. So you will have volatility clusters. Volatility is not constant, and these are very important stylized facts about log returns, and we'll see this every now and then during this lecture. Well, Deutsche Bank AG volume of traded shares. Trading volume. Again, you can see it increases, drops again, increases again, drops again, stays low, increases, drops, and it starts to increase again. So even the trading volume, the liquidity, and this is actually a proxy for the liquidity of a stock, the trading volume goes up and goes down. And we need to come up with models because this can pose a threat to us. If you are invested in Deutsche Bank stock, and you want to sell your stock, you need liquidity. Imagine this example where you have bought the stock for 100, or you can buy it for 100, and you can only sell it at 50. So if the stock is very illiquid, this is bad for you. You will lose a lot of money simply because the stock is not liquid. So it could be that modeling the liquidity of your investment is also a sensible thing to do, and you need to keep this in mind. Then, completely different data. This is the Danish fire insurance data sample that is available in R. You can see here it's the package T in R, or the R project. And you can access insurance data from Denmark, from all of Denmark, in Danish kroner. And these are all the fire insurance claims in Denmark. And you can see this is a pretty large loss. I don't know what burned down at this point in the early 80s, I guess in 1980 or in 1989 and 1991. But these are three extreme fire losses. So something very large must have burned down. And in between you have a lot of small claims. And this is completely different data compared to, say, the log returns of a pretty standard stock like Deutsche Bank. So this is insurance data. You need different models, and we'll model this data as well. If you're thinking about downloading this data, and I would urge you to do this at home, you simply go to R, you load this library T, and you say, okay, data is initialized with Danish. The data is actually called, the array is called Danish. And then the data is available in data, and then you can plot it, for example, as a vector. And this is simply the plot command using year and insurance claims in million Danish kroner for the X and Y axis. And this gives you this plot. So if you want to play a little bit with the insurance claim data, just use this and load the R project library T, and then Danish gives you the Danish kroner data. Someone asked, which one should we download? Well, actually, I don't think there's too much of a difference. I would use the R release zip file. Try that one. If not, try a different one. No? Usually the release one should be working. Okay. I've already talked about returns. So let's properly define returns. Returns are defined as the relative change in the price of a financial asset. Could be a stock, could be a bond. We can actually define returns as well for something like fire losses. This is very uncommon. If it's a price of an asset, we'll usually talk about and we'll call them returns. If it's something else, but we still want to look at relative changes, simply call them relative percentage changes maybe. It's weird to talk about returns in the context of this fire data, but you can still look at relative changes, of course, at percentage changes. So usually we'll have an asset, we'll have a price, and then we can use the simple returns, the discrete returns, which are simply given by the price PT minus price one period before that relative to the price at t minus 1. So it could be 100 minus 90 divided by 90, and this gives us the return RT. Now, most of the time we'll be working with continuously compounded returns, aka log returns. Why? The problem with the discrete or simple returns is they are discrete. Meaning what? We want to model returns. And if we are using simple discrete returns, we should be using discrete distributions. But as it is so often the case in statistics, everything gets easier when we use continuous distributions. Stetige Verteilung. Stetige Daten. So that's one reason, one very simple reason why we're using continuous returns, log returns. How can we compute these log returns, YT? We take the natural logarithm, so this is actually ln of pt divided by pt minus 1. This is the natural logarithm of the price pt divided by pt minus 1. And if you know the rules for working with a logarithm, you know that this is the difference between log pt minus log pt minus 1. And it is nothing, or it's simply the log of 1 plus the simple return. Again, one reason for why we're using continuous returns is that it's simpler and it is easier to use continuous distributions later on. And this is one reason. Another advantage is, now consider the compounded returns YT. So we are computing YT as the difference of the logarithms of PT and PT minus 1. And then we define the return from the very start to the very end. So let's assume we are buying the stock of Deutsche Bank right now, and we want to compute the return, the so-called, let's write it down, the so-called buy and hold return from, say, October 1st to December 31st. This is the so-called buy and hold return. I'm not looking at the daily return from today to tomorrow, tomorrow until the day after tomorrow, and so on, but I want to compute the buy and hold return buy now and sell on the very last day of this year or in 1 year. Then you can see that this buy and hold return, y capital T, is given by the logarithm of pt capital T divided by p0. And this is what? Simple working with the logarithms. And in the end, you can see the buy and hold return is given by the sum of the daily log returns. Meaning what? If you know that, for example, we have Deutsche Bank goes up by 1% today, minus 2% tomorrow, plus 3% afterwards. If you're interested in the buy and hold return, you can do the following with the continuously compounded return. 1 minus 2 plus 3% gives you the buy and hold return. This doesn't work for simple returns. That's one of the reasons, again, a second reason why we are using log returns most of the time. Okay. Well, that's what I just said. The log return for time period is the sum of the log returns of partitions of the time period, and you can compute the buy and hold return. For simple returns, we have the following. The simple return of a portfolio is the weighted sum of the simple returns of the constituents of the portfolio. So now consider a portfolio. Very simple example. 50%, 50% Deutsche Bank, 50%, 50% Commerzbank. Now in this case, for simple returns, it's very simple. We have two constituents. We have portfolio weight 0.5, 0.5. Simple returns R1, R2. And the portfolio return is simply given by what? Let's say Deutsche Bank goes up by 12% and Commerzbank goes down by 4%. And we would simply compute 0.5 times 12% plus 0.5 times minus 4%, and this gives you the weighted return of the portfolio. This can be done for simple returns. So let's do this here. Quite simply, we take the T-series library in R. So load the library. We get the prices. In this case, the T-series library already includes stock price data from Yahoo Finance, so it's freely available. You don't need to go to DataStream. You don't need to go to Bloomberg or DataStream. You can use this T-series library, and you say price, get historical quote, instrument dbk.de, that's Deutsche Bank, and we calculate the log returns by taking the daily differences. This is what diff does, of the logarithm of the price data, and then we plot it, and we plot the returns with the year and log returns on the X and Y axis. And this is what gives you this plot. Okay. So this is financial data and very simple operations using returns. And you can note, and you can try to remember, please try to remember, that we are almost exclusively will be working with log returns. It's almost always about log returns. Now, what types of statistical variables do we have? We have different levels of measurement. For example, we have a nominal scale, gender. We have male, female, transgender, and maybe even more, or undefined. The important thing about the nominal scale is that you don't have a natural ranking. One isn't better or worse than the other one. With an ordinal scale, you have grades 1, 2, 3, 4, 5, 6. You do know that there is a natural order. A 1 in the German grading system is better than a 2, and a 2 is better than a 5, which is a failing grade, but you cannot interpret the differences. So is a 1 2 times better than a 3, or is a 3 1 time better than a 4? Not really. So you have an ordering, you have an order and a ranking, but you cannot interpret the difference. With the interval scale, this is different because you do have, you can say that, for example, 20 degrees is much warmer than 0 degrees, but you're working down on the scale until you finally arrive at a metric scale where you have a natural fixed point, you have a natural 0, same with the temperature, but you need to fix it, and you can interpret all those differences. For example, $20, it's 2 times more than $10. $50 is the half of $100. So this is true, and we need to look at metric scales and metrically scaled statistical variables. It could also be that we sometimes have variables that are qualitative in contrast to quantitative and discrete versus continuous. But again, most of the time we have continuous quantitative variables on a metric scale. That's what we are dealing with here. Yeah? Money. Okay. Any questions so far? Before I continue to the descriptive and inferential statistics. So it doesn't seem as if you have any questions. And by the way, thank you for inserting the script in the chat window. I wasn't aware that this works in Zoom, but very nice. So let's start with very, very simple statistics. And we'll start with sample statistics. Now, you know that in statistics, most of statistics is concerned about what? We have our full set, which is usually called omega, and anything can happen in omega. And what we do is, this is, for example, the population of Germany. And we want to know what party people will vote for in the next general election. We cannot ask all, let's say, 50 million eligible voters. So the size of omega would be 80 million. And we cannot ask and we cannot interview all 80 million. So what are we trying to do? We are looking at a sample. This is our sample. And we try to use statistics to make some claims, to test some hypotheses based on our sample on omega, on the full set of events, on the full set of observations. That is sample statistics in a nutshell. You can say this in German again. Das ist natürlich hier ganz einfache inferenzielle Statistik. Wir haben eine Grundgesamtheit Omega, 80 Millionen Bundesbürger. Wir können nicht alle 80 Millionen befragen. Was machen wir? Wir ziehen eine Stichprobe und wir schließen, deswegen nennt sich das ja auch schließende Statistik, wir schließen dann auf Basis dieser Stichprobe auf die Grundgesamtheit. So let's say we have observed values of a random variable, and these are denoted by x1 to xn. So we have a sample size of n, could be 50. Then the first thing we want to try is on a nominal scale, for variables on nominal scales, we cannot order these values. But if we have at least an ordinal scale, we can use this ascending ordered sample. So we order them according to the scale. And this is called an order statistic. Ja? Also das ist eine, I don't actually know the German word. Das ist eine Rangstatistik. This is a order statistic. In German it's Rangstatistik. And then for this order statistic, we can look at the median. The median is defined as what? If we have, for example, 50 observations, we can order all those observations according to our ordinal scale, and then the median is simply given by take, for an even n, take, well, let's make a small example. Let's say we have an ordinal scale, we have grades. We have 10 people in our class, and the final grades will be 1, 1, 1, 3, 3, 2, 1, 4, 5, 2, 4, 6, 8, and 1. So these are the grades. They are not ordered yet. So what we need to do is we need to order them. So the ordinal scales will start with the 5, say 4, 4, 3, 3, 2, and then 1, 1, 1, 1. So that's the order statistics. That's the first order statistic, the second order statistic, etc. And then the median is simply looking at the ordered variables and making a cut right here. So the median, if n is odd, would simply be one of these values. Let's assume this one is gone. Then it would be exactly the 3. Or as n, in this case, 10 is even, we need to take this value here, we need to take this value, take the average, and the median in this case is 2.5. So that's the median. This can be done for ordinary scaled data, as you can see here with our example of grades. So that's the median. It's even simpler, obviously, for metrically scaled variables. Then we can calculate the arithmetic mean. That's usually the simple mean. The simple mean is just defined at that. Take all those values, take the sum, and then weight it by n. And this is the average. This is the arithmetic mean. And you can take the same in a slightly different from the geometric mean, the geometric average, which is simply multiplying all those values and taking the nth square root, or the nth root of this. So this is the geometric mean. Now, sometimes you want to use the geometric mean, sometimes you take the arithmetic mean, and we'll come to that later on. Now, next, we need to think about some measures of variation. So some measures of variability, of variation, or volatility. I don't want to use the word volatility because it's already fixed and we understand something very important under volatility. So we're talking about measures of variation here. The first thing is the range. It's defined as the difference between the last and the first order statistics, which in this case is simply the, well, it's as you would say it in English, the grades range from 5 to 1. That's the range. If, in contrast, we only had values like this, grades, then the range would be from 2 to 4. That's the range. Okay. Now, the interquartile range is defined as the 75% order statistic minus the 25% order statistic. Now, if you've taken the statistics class, you should know that the median is also which quantile? It's also the 50% quantile. So that's the median. And if you take the first and the third quartile, you can take the interquartile range, which is not from the very first to the very last order statistic, but between the 25 and the 75% quartile. Okay. And then last but not least, we have the empirical variance S squared and the empirical standard deviation S, which are defined as follows. You take the values x1 until xn. Those are not the order statistics, by the way, but these are the observations in your sample. You subtract the average, the sample average, the arithmetic average. You take the squared differences, and then you take not exactly the average, but you weight it with 1 minus n minus 1. Now, this looks pretty much like the usual definition of the variance of a random variable, but this is the empirical variance. This is an estimator for the variance. And does anyone know why you need to look at this 1 over n minus 1 and not at 1 over n? Any idea? Write your ideas in the chat window, please. Anyone an idea? Anyone who's remembering the statistics class? No idea? The problem is that s squared is, if, for example, we take with 1 over n, if it were defined with 1 over n, then this would be a biased estimator of the variance of x. This is the problem. And a biased estimator, this one is actually unbiased. So what we have is the expected value of s squared is the variance of x. So s squared is an unbiased estimator of the variance, and only if you take this 1 over n minus 1. I'll say this in German again, so that you understand this. Wir reden hier über die Stichprobenstatistik. Das ist der empirische Schätzer für die Varianz in der Grundgesamtheit. Und in der Statistik sollten Sie gelernt haben, dass wenn Sie hier einfach die gewöhnliche Definition der Varianz nehmen, nämlich 1 durch n mal und dann hier die Summe der einzelnen quadrierten Fehlerterme, dann ist das ein verzerrter Schätzer. Dann können Sie relativ einfach zeigen, dass der Erwartungswert von s Quadrat, dass der nicht die Varianz in der Grundgesamtheit ist. Und das ist dann ein Problem. Und dann müssen Sie nämlich sehen, wenn Sie stattdessen s Quadrat mit 1 durch 1 minus 1 definieren, dann ist das Ganze wieder unverzerrt. Und deswegen ist das hier der Schätzer für die Varianz in Ihrer Stichprobe für den Varianz in der Grundgesamtheit. Okay. And last but not least, obviously, if you take the square root of s squared, you get the empirical standard deviation or the empirical volatility in the sample. Okay. Now, sorry for that. We do have some other measures we are looking at from time to time. The first one is the sample skewness, and the second one is the sample kurtosis. Now, what is skewness and what is kurtosis? Imagine you have a statistical distribution that looks like this. This one here looks pretty much like a normal distribution, and this looks quite symmetric. If it is symmetric, it is not skewed. So skewness is the opposite of being symmetric. A skewed distribution will look like this. So it's tilted to the left or to the right, and you can measure this degree of tilt, of being tilted, by looking at the skewness. And this is the sample skewness. It's defined as m3 divided by the third power of s. And kurtosis is what? I'm trying to erase this. Do I have an eraser? No. There's my eraser, yes. No, where's my eraser? Okay, I cannot access my eraser, sorry for that. If this, for example, is the normal distribution, you can have this type of distribution, which has fatter tails than a normal distribution. Or you can have something that looks like this, which has less probability in its tails than a normal distribution. And this is what we call platykurtic or leptokurtic. And this is the sample kurtosis. So if it's positive or negative, it has less fat or more or fatter tails than a normal distribution. I'll say this in German again. Die Kurtosis oder die Wölbung einer Verteilung ist immer ein Vergleich zur Normalverteilung. Wenn Sie also diese Normalverteilung haben und die Ränder sind fetter, haben also mehr Wahrscheinlichkeitsmasse, dann spricht man von Fat Tails, von fetten Rändern oder eben auch von Leptokurtosis. Wenn dagegen die ganze Verteilung eher zusammengestauchter ist, aber immer noch natürlich symmetrisch ist, das hat nichts mit der Schiefe der Verteilung zu tun, und Sie in den Rändern der Verteilung weniger Wahrscheinlichkeitsmasse haben als in der Normalverteilung, dann nennt man das platykurtisch. Und das ist die Kurtosis oder die Wölbung der Verteilung. Okay. So let's compute some of these measures for some data, again from R. We get ourselves the price data for Deutsche Bank, we compute our log returns, and then we calculate the mean, that is the arithmetic mean, the standard deviation, the minimum, the maximum, and we round some of the statistics which you can get with summary. Now, I'm simply using the round command so that the results will fit on the slide, but you can see the minimum, the median, the mean, and you can get the first quartile and the third quartile and the maximum value, which we've already gotten here. Well, it's rounded obviously, but this is what summary gives you. So summary gives you some summary statistics. They are also called summary statistics, and we get a first idea of what the data looks like. And you should always do this. Every time you are working with data, with real data, make sure you first look at some statistics and some sample statistics to make sure that you get a feeling for the data. And if you were to see that the maximum return, for example, is 100 or let's say 1,800%, this would be highly unrealistic. This would be highly unrealistic. So again, the minimum value here and the maximum value tells you that there shouldn't be any outliers, right? Okay. Someone asks, how can we gain access to R via the SC account? What is the SC account? R is freely available for download on the internet. So I'm not so sure what SC account is. Maybe you can clarify that. Okay, then by looking at skewness and kurtosis, you can calculate the skewness and the kurtosis of this data. And the first thing you observe is if it were symmetric, the skewness should be 0. As you can see here, it is not 0, so the data is skewed. And it's also leptokurtic. A simple way to test whether this data looks like, actually, does anyone have an idea what the Jacques-Berat test does? What is the hypothesis for the Jacques-Berat test? We can use R via the Uni Leipzig software site. No, you can download it from the website of the R project. You can simply use the free version. That's okay. Any idea what the Jacques-Berat test does? It's a test for normal distribution. And in this case, you can run it on the returns here. On returns, the hypothesis that is being tested is that it is normally distributed. And what does the test tell you? This is the result here of the Jacques-Berat test. What does this result tell you about the data? Any idea? No one? The test result, which you can interpret, is the p-value. And how do you work with p-values? Basically, first thing to see is that the p-value is smaller than 2.2 times 10 taken to the minus 16th power. So basically, the p-value is 0.000. Okay. And what does this p-value tell you? Yes, exactly. The p-value is below, say, 5%. So at the 5% level, we have to reject the hypothesis of H0 that the data is normally distributed. So you could already see this from the kurtosis and the skewness. The data is obviously skewed and it's leptokurtic. So these are two indications that the data is not normally distributed. And fun fact on the side, the Jacques-Berat test works exactly like this. It takes the skewness and it takes the kurtosis, and if either or both are too large compared to a normal distribution, the Jacques-Berat test will immediately say, no, the data is not normally distributed. No? So let's look at this here in more detail. We'll look at the autocovariance or autocorrelation function. What is the autocovariance or autocorrelation function? Any idea what the autocorrelation is? Well, if you, for example, have x1, x2, x3, x4, and so on, you can look at the covariance or the correlation between xt and xt minus 1. And if you take this autocovariance at leg 1, it tells you how are the prices or the returns today correlated with tomorrow's returns. And this is what we can do now. We take the autocovariance function, the ACF, of the returns. The maximum lag is said to be 5. We don't want to plot it. And this gives us the autocorrelations of the series returns by lag. Any idea why the autocorrelation at lag 0 is 1? Why does it have to be 1? This is simply the correlation between x, t, and x, t, because the lag is 0. And obviously the correlation of a variable with itself is 1. But as you can see, between t and t minus 1, the correlation, the autocorrelation, is 6.5%. And at lag 2, it's minus 5%. At lag 3, it's minus 1%, minus 1%, and minus 7%. And here you can also look at the squared log returns. And this is a stylized fact. Usually, if you take log returns, the autocorrelations and autocovariances will be very small for the original return series, but they can be extremely high when you take these squared returns. And here you can see this. The autocorrelation for the squared returns at lag 1, they are 23, at lag 2 they are 27%, 33% at lag 3, and so on. Okay. The next thing you can do with the data is you can look at the box plot of Deutsche Bank log returns. A box plot is what? It is a bar here for the median. It's, I think, 25 to 75% here in the box. And you can look at the outliers beyond a certain point here as these dots, and you can see how the data is distributed. A second way of plotting the data is a normal quantile plot. What is that? This is a way of plotting the theoretical quantiles against the sample quantiles, and this is done for the comparison against a normal distribution. Now usually, again, someone calls me, no problem. Again, what you can do is, Let me see if I have a line. Oh no, unfortunately I don't have. I need to plot it this way. Now, if the data were normally distributed, it would look like this. Think of this as a line. So why? Because, for example, this is the theoretical quantile, and this is also the sample quantile. This is the theoretical quantile, and this is also the sample quantile, and so on. Problem is, if it's not a straight line, but if it's something like this, or like this, you can see that the theoretical quantiles and the sample quantiles differ. So it's definitely not a normally distributed data sample. If it were, it would look like this. Simply a straight line like this. Well, it's not really straight, but you get the idea. Okay. And then, last but not least, you can take the data and you can do a density plot. You can use the command density returns, very simple in R. And density gives you an estimate of the density of this data. And then you can also plot the normal distribution, which would be the corresponding distribution. And again, this is completely different. You have high differences here and some kurtosis here. Here it is okay. So yeah, this data set is definitely not normally distributed. Okay. What can you do else? Now, again, remember why we are trying to do this. We are trying to get a better idea of the data we are looking at. So we can use contingency tables, we can use scatter plots for 2 metric variables, we can use a splatter plot matrix for more than 2 metric variables, box plot and KO plots, and so on, just to get an idea of what the data looks like, if there are any outliers, if there are any inconsistencies in the data, or if there is anything that is odd. And here, obviously, we shouldn't start by looking at a normal distribution. This plot immediately tells you we need a different model and not a normal distribution. Okay, so the first one is a scatter plot of Deutsche Bank, where there's the DAX 30 log returns with a linear model laid in between. Very simple. You can see that it is not really... You have some tendency here to go down with Deutsche Bank stock. It looks like the data is a little bit tilted into this way here, and most of the observations are obviously here in between. So this looks okay. If we take the DAX 30 log returns minus 5% and above minus 5%, we can look at different box plots to get a better idea of the data. And these are just 2 examples for additional plots in 2 dimensions, because now we have DAX 30 and Deutsche Bank, or we are comparing 2 types of DAX 30 and Deutsche Bank stocks. So this is one way of doing this. Okay, we've already talked about the autocorrelation and the autocovariance, so let's go one step back and look at the correlation coefficient and the empirical covariance and the empirical correlation. Now, in the sample set, right, in the full set, the correlation coefficient is what? It's R, and it's defined in this way, and it is simply as the correlation, or no, the standard deviation of X and Y divided by the standard deviation of X and the standard deviation of Y. The SX is obviously the standard deviation, the empirical standard deviation of X and of Y, and the empirical standard deviation of X and Y, this empirical covariance, as we call it later on. The empirical covariance is, again, the standard covariance with one slight difference here, because we are talking about the sample statistic. It's not n over 1. no, 1 over n, it's 1 over n minus 1. Okay. How do we compute all these measures? How can we estimate all these statistics? Now, maximum likelihood comes into mind, and usually we'll be using maximum likelihood. Was suggested by Fisher. It's one of the basic approaches and methods in statistical inference, and it can be used to estimate, for example, the parameter p of a binomial distribution, or the variance sigma squared of a normal distribution, and what it's all about. Okay, now imagine you have a sample x1 to xn from a population x. That is, x1 to xn are identically distributed and independent. So it's an IID random sample. Now, we have fx of x given the parameter theta. This is the probability density function, or the probability mass function if it's discrete, of x. And we have our random sample x1 to xn. Now we assume that we know everything about the probability density function, with the exception that we don't know the unknown parameter theta. So what we need to do is we need to find a statistic t. We need to find an estimator in which we can insert the sample observations xn to x1, and this result will approximate the unknown parameter theta as good as possible. And the maximum likelihood method works if theta is real valued, as well if it's a vector of real numbers. So what we need to do is we need to set up the so-called likelihood function. The likelihood function is what? It's simply, it's actually proportional to the product of the density at each point given a certain parameter value theta. And the product is due to the assumption of independence between all those samples and sample observations, because x1, x2, x3, those are our sample observations, and because they are drawn randomly from the full population, they are assumed to be independent, and if they are independent, the probabilities will be independent as well, and then it's simply probability times probability. You know this from throwing a dice 2 times, it's just 1 over 6 times 1 over 6. For a fixed random sample, this function L can be viewed as a function in theta, in the parameter. So what we need to do is we need to maximize the likelihood, and then we get the parameter theta that gives us the highest likelihood that this is the true parameter. That's why we call it likelihood. And we maximize the likelihood function, and then the estimator theta hat ML can be interpreted as the estimate which maximizes the probability of a random sample and is therefore the most plausible one if the parameter is true. And this is this is a likelihood function. To make it simpler, because we have a product here, we take the log likelihood function. And if you go back to the returns, you know that if you take the log of a product, you get the sum of the individual logs. So you take the log of the likelihood function. For maximizing, this doesn't make a difference, and you get a constant plus the sum of all those logarithmic densities and likelihoods. And because log is a monotonously increasing function, it gives you the same result. So if you maximize the likelihood or the log likelihood function, it gives you the same parameter estimate for theta. So in practice, it's usually nicer to look at the log likelihood. You differentiate the log likelihood function with respect to theta, and you look for the roots of that derivative, and what you get is a first order condition to get a local maximum, and then if you have the maximum, you know which is the best estimate for your parameter. Now, some results. Maximum likelihood estimation is consistent. It's asymptotically normally distributed and thus asymptotically efficient. And if n denotes the size of the simple random sample ln, the log likelihood function, and theta hat mln, the maximum likelihood estimated for the true parameter theta, then you can show that theta hat converges to theta and it's consistent. So what does this mean? If you have a sample size of, say, 10, you will get a good estimate. If a sample size of 1,000 observations, the maximum likelihood estimate will converge to the true parameter. And if you only increase the sample size, at some point, you will get almost the same parameter as in the population. And you can leave out the Fisher information matrix. This is simply the some additional information, but important here is this. The parameter, the statistic, converges. If you subtract the true parameter theta, it converges to something that is normally distributed with a mean of 0. So the difference, this here actually, this is the estimation error. This estimation error converges to 0, and what you get is normally distributed. That's maximum likelihood. I'll explain this again in German because we have some time here. ML-Schätzung, Maximum Likelihood-Schätzung, ist eigentlich die Standardschätzmethode in der Statistik. Und es ist relativ einfach, was Sie sich da überlegen. Gehen wir mal zurück zu unserem Beispiel. 80 Millionen in der Grundgesamtheit. Sie ziehen eine eine Stichprobe mit 1000 Beobachtungen. Was Sie jetzt haben wollen, ist eine Statistik. Eine Statistik ist ja nichts anderes als eine Funktion, die Ihnen sagt, wie Sie einen Parameter schätzen sollen. Und egal, was für einen Parameter Sie jetzt schätzen wollen, Sie gehen jetzt einfach erstmal davon aus, die Daten sind irgendwie verteilt. Sie unterstellen irgendeine Wahrscheinlichkeitsfunktion, irgendeine Dichte. Und diese Dichte hat noch einen Parameter Theta. Und jetzt wollen Sie Theta schätzen. Und unter dieser Annahme basteln Sie jetzt sich eine Statistik, in welcher Art und Weise. Sie sagen einfach, Sie nehmen diese Dichtefunktion. Sie müssten dort die einzelnen Werte xi, x1, x2, x3 einsetzen unter diesem speziellen Parameter Theta. Und dann, weil Sie die Stichprobe zufällig gezogen haben, sind die alle unabhängig. Das heißt, Sie können die Wahrscheinlichkeiten miteinander multiplizieren. Wenn Sie das tun, kriegen Sie dieses Produkt der einzelnen Dichten und dann müssen Sie das Ganze maximieren, weil Sie sagen, Sie wollen die Wahrscheinlichkeit dafür, dass diese Stichprobe tatsächlich aus der Grundgesamtheit so resultiert ist, diese Wahrscheinlichkeit wollen Sie maximieren. Man nennt das dann halt die Likelihood, dass also letztlich diese Stichprobe aus der Grundgesamtheit stammt. Und wenn Sie das maximieren, suchen Sie dann also hier den Wert Theta, der die Likelihood maximiert. Das Produkt ist sehr umständlich, also logarithmieren Sie das Ganze, dann bekommen Sie hier eine Summe. Ändert an der Maximierung nichts, weil der Logarithmus ist eine monotone Funktion, streng monoton steigende Funktion und damit ist das Theta immer dasselbe, ob es jetzt nun L oder log L maximieren. Und dann machen Sie nichts anderes als, was Sie auch in der Schule schon kennengelernt haben. Sie suchen letztlich erstmal die Ableitung, bilden die Ableitung, setzen die gleich 0 und dann suchen Sie das Theta, das eben hier die Bedingung erster Ordnung erfüllt, nämlich dass die erste Ableitung gleich 0 ist. Dann bekommen Sie ein lokales Maximum, hoffentlich. Und dann hat Fisher gezeigt, dass dieser Schätzer, die Funktion kann also beispielsweise so aussehen, hier. Das sind ja nichts anderes als Statistiken. Ne? Das hier. Das ist eine Statistik. Das ist ein Schätzer. Das ist eine Statistik für die Wölbung oder die Schiefe in der Grundgesamtheit. Und ich könnte jetzt auch sagen, ich nehme jetzt hier M5 und ich sage, ich definiere M5 mit 1 durch n Quadrat mal diesen Ausdruck. Ist das jetzt eine gute Statistik? Ist das ein guter Schätzer? Weiß ich nicht, müsste ich jetzt erstmal mit ML überprüfen. Ja? ML ist eindeutig, also hier kriegen Sie genau M3 und M4 raus, aber es könnte ja sein, dass M5 besser ist. Das müsste ich dann testen. Und dann müsste ich schauen, ob ich damit den ML-Schätzer gefunden habe. Und Fisher hat hier gezeigt, wenn ich diesen Schätzer nehme und Theta, den zu schätzenden Parameter, abziehe, erstmal lande ich dann in Summe wieder bei 0. Das Ganze konvergiert, wenn klein n gegen unendlich geht, ich also die Stichprobengröße erhöhe, geht das Ganze gegen 0. Und das, was rauskommt, diese Werte, diese Fehler letztlich hier, die sind normal verteilt mit diesen Informationen und dieser Fisher-Informationsmatrix. So that's maximum likelihood estimation. Actually, very nice way of coming up with an estimator for an unknown parameter of your data. And last but not least, let's talk a little bit about linear and generalized linear models. So we've already seen in some of our plots that I've inserted here, for example, this blue line. This is nothing but a linear model. This is a linear estimate of the data. In this case, it looks pretty good. In some other cases, it doesn't. But we need to know what these linear models look like. So we start with the simple linear regression model that covers the case of one dependent variable y and a single one-dimensional explanatory variable x. In the multiple linear regression model, you have one y, but a vector of explanatory variables x1, x2, x3, and so on. And the multivariate linear regression model generalizes the multiple linear regression model to the case of various potentially correlated dependent variables. So you have multiple and multivariate linear regression. So the most common model in practice is multiple linear regression. It can be represented by y is equal to x times beta plus epsilon. Epsilon is the vector of errors and beta is the vector of regression coefficients. And you might know this from school, or you should have learned this in econometrics. Under certain assumptions with some certain conditions being met, you can obtain the correct, in some sense, the best estimate for the coefficients by looking at the least squares estimator. And the least squares estimator is given by beta hat is given by x transpose times x inverted times x transpose times y. x' hoch minus 1 x', kennt man aus der Ökonometrie. Das ist der OLS-Schätzer. This is the OLS, the ordinary least squares estimator in regression analysis. That's OLS. Now, sometimes you do not have a metric variable, but you do have a Bernoulli distribution here. And this means that you have two or maybe more possible outcomes. And you have a probability pi, for example, that y is 1. So dead, alive, male, female, default, non-default. That's a logistic regression. You want to, let's make this example where the default 0 is no or non-default and 1 is default. In this case, you cannot use ordinary least squares and you cannot use multiple or ordinary linear regression models. Why? Because you want to make sure that the resulting y is not below 0 or above 1. So you need logistic regression, and the dependent variable is supposed to follow a Bernoulli distribution with a certain probability for 1. This probability pi is estimated by this here. This is what we call a logic or logit. And we use the logistic function. And again, here you can see using the logistic function, you can write those probabilities for a company being in default. And as a result, the expected value here is not directly depending linearly on x, but only after transforming it by using the function h. And actually these are the odds, the probability divided by the 1 minus the probability. And if you take the logistic odds, you get the logits, the logits. So this is the logistic model, and it can be seen as a special case of a generalized linear model. We'll see this later on in time series analysis. But at this point, simply keep in mind that we have linear regression and we have logistic regression in case our dependent variable. We don't care about the explanatory variables. If the dependent variable is a 1, 0, is a binary variable, you need to use logistic regression. So let's do this here in R. first of all, we simulate data. We take our UNIF, which simulates data from a uniform distribution on this interval from -5 to 5, and we simulate 25 values. We simulate the error terms from the standard normal distribution. So R norm, in contrast to R UNIF, gives you 25 points from 25 observations from the normal distribution, standard normal distribution. And then Y is -20% times X plus the error term, and we estimate the linear model by looking at this here. LM stands for linear model, and we have to write Y tilde X, which is the command in R to give you a linear ordinary least squares model using this data. If you do a summary of the model, you can see the results are written in model. And if you access the summary, you can see this is the call, this is the model that is being estimated. You get the coefficients, the coefficient estimates, they are given here. And you get the R squared and the adjusted R squared. And in this case, the adjusted R squared and R squared respectively are 8.8 and 12.6%. Now to plot this, we plot the simple linear regression model with the command AB line and AB line. You can try this out at home. And this is what we are looking at. We have the true parameter. Now remember that the true parameter here is 20% minus 20%, and the intercept is 0. And you can see here the true parameter. This is the true model in red, and the estimated parameter model is given in blue. Why is it not as good as the true parameter, as a true model? Well, we are only basing this on 25 observations. We have a sample size of 25, and you can try this at home, increase the number of points, and then estimate the model again, and you will see that the red and the blue line, they will converge together because we now have more data, and the OLS estimator will converge to the true parameters. Okay, just to conclude this at this point here, actually these models, taking data, taking statistical models, especially regression analysis, taking samples, using resampling, etc. This is what is nowadays done in machine learning, because you have a huge set of data, you have this huge sample, and you use regression analysis, use variants of regression analysis to come up with these models, the red or the blue line, and even, of course, in higher dimensions. And this is what we nowadays at some points would call machine learning. You can do two different types of machine learning. The first one is supervised learning. Supervised learning aims to learn a function that maps an input to an output, as we've just done in our example, and the learning is based on examples of input-output pairs. Now, if the output is a metric variable, the machine learning method corresponds to basically a regression analysis. If we have discrete variables, it corresponds to classification or logistic regression. And then, for an assessment of the forecasting error, you divide the data set into a training and a test data. And you make sure that you model your data based on your training data sample. And then you have the test data sample, and you can check whether you have done a good modeling and if you're a good way of coming up with a model. Alternatively, you can also do cross-validation, but we'll talk about this later on. In unsupervised learning, in contrast, it works on data that has not been labeled or not classified. So what you're trying to do is you're simply trying to isolate clusters, data that looks similar. And this is very similar to cluster analysis, and cluster analysis is also a type of unsupervised machine learning. Okay, so this has been a short recap of basic statistics, of inferential statistics. And next we would be talking about statistical distributions, stochastic processes. But as we've already run out of time exactly at a quarter to 3 o'clock, I would say we stop here. Do you have any questions? Anything else you want to talk about? please write it in the chat window. And if not, thank you very much for your attention. Sorry for the inconvenience of having to switch to Zoom for today's lecture. Next week, hopefully the Big Blue Button working space and the Big Blue Button room will work again, and you will be able to access the data and the script and the slides on the Moodle site. So if you don't have any questions now, I had a problem with the sound. My computer missed basically the whole introduction part. I don't need to repeat that. You can simply watch the YouTube video. It's all in the recording, so just have a look at that. If you still have some questions, just contact me. I'm happy to discuss and answer all your questions and discuss the organization of the class. So thank you very much again, and see you next week. Thank you.